Hey everyone, Kimo Quance here with the Kimo Quance Group. Today we're going to talk to you people who want to sell your property in California, move the equity you have somewhere else, or within the state if you want to, but I imagine the majority of you actually want to sell and get your properties out of California, your investment properties. We're going to talk about 1031 exchanges, how to use them, kind of the rules, and what the process is to do that. I do want to address though, this is not legal advice. Obviously seek a CPA or a 1031 accommodator. I use AX1031.com for my own properties and clients. They do a great job, but there's many other ones, and obviously talk to your CPA as well. But what a 1031 exchange is, I'm going to read kind of the definition here. A 1031 deferred exchange allows real estate investors to defer the payment of capital gains taxes when selling an investment property and exchanging into another investment property. There are several types of exchanges available to investors depending on how they wish to structure their transaction. So the majority of people, what they'll do is they'll sell their property and then they'll purchase another investment property, and it's got to be like kind. So we're not talking about if you live in the house, owner occupied. We're talking about investment properties. So whether you own a warehouse and you want to buy a fourplex, whether you own a piece of land and you want to buy a fourplex, if you own a duplex and want to buy a single family house, as long as it's investment and that's what it's used for, that's what you can do. And it can be within the 50 states here too, so it doesn't have to be within the same state. So what we're seeing is a lot of people selling their properties here because a lot of times the tenant laws here and getting them to more tenant-friendly states, and obviously taking your California dollar, which goes a lot further in other states too. So most people, what they'll do, they'll sell their property and then buy another. There's a couple other ways you can do it. You can do a simultaneous exchange, which means you're buying the property and selling your property and they close essentially at the same time. There's a reverse exchange where you buy your property first and then you sell the one prior, and then there's construction ones as well. So the basic guidelines are the property qualifications. So like I said, it's got to be basically a like-kind property. It's got to be a property that's an investment property. Whether it's, like I said, a warehouse or a duplex or a fourplex or single family, as long as it's a investment type property. And then you have to look at the timeline. So the clock starts when your initial property closes. So you sell your property, it closes, you want to take that equity you have, that capital gains you have, and not get taxed on it. Basically, from that time it closes, you have 180 days to close on the next property, okay? So, but you have 45 days to identify the property or properties you want to buy. And there's two ways to calculate that. You have to pick 3 properties within the first 45 days that you're going to buy, one of the 3, or you have the rule of 200%, which means you can pick more than 3 properties as long as when you add them up, it doesn't equal 200%, more than 200% of the property you're selling. So if you're selling a $500,000 property, you can buy 10 $100,000 properties, because that's $1 million, which would be 200% of the 500,000, if you can find those $100,000 houses. But that's a way to get to more than just the 3 properties. I have my cheat sheet here, and then the tax deferral. So basically, you can roll over that money into the new property and use it all. And it's got to be an equal or higher value. There is a way to buy a property that's less, but you'll get taxed on a little bit of that money. And then also too, say you have $300,000 you're rolling over into another property that's equal or greater value. If you wanted to say keep $50,000 and just roll over $250,000, now you can get just taxed on that $50,000 versus all $300,000 since you roll over part of it. So you can roll over all or some into the new property, but whatever you don't roll over, you will be taxed on. There's not really any rules according to the IRS as far as how long you have to own the property to be able to do so, as long as it's an investment property. But some advisors recommend that you're holding the property for at least a year. Yeah, and so the last thing you really want to do is reach out to me, Kimo Quance, or anybody on my team to chat about 1031 exchanges, how they work. Like I said, we work with the 1031 exchange accommodator to make sure all the ducks are in a row, because they're very strict on the rules to be able to make sure that that money gets transferred over and become tax-free, right? Or don't get taxes on them. So let us know on those. If you have a property here in California that you're looking to sell and either buy something in California or take that money elsewhere in the country, let us know. We'd love to help you out on your 1031 exchange. Thank you so much for watching our video. My name is Kimo Quance.